Hey guys, what is going on? Welcome back to my Robinhood portfolio. What I wanted to do today is talk a little bit about expense versus cost. This came up because in one of my comment threads, a viewer was saying it's much easier for a stock to go from $1 to $10 than it is to go from $100 to $1,000. So that's why penny stocks are such great investments. I kind of disagree with that. I disagree with that actually quite a bit. So I thought I'd just kind of talk about expense versus cost with a few examples and kind of delineate between what a good investment is, what's a costly stock, and what a terrible investment is, or what is a very, very expensive stock. So Berkshire Hathaway here, Class A, you can see it's a very, very costly stock, $255,040, and some may also say it's very expensive. Google here, you can see $850. And Cara Therapeutics, a very popular stock for penny stock trading, is $15. So you may say this is a very expensive stock, this is less expensive, and this is the cheapest stock of all. However, I'll take a little bit different look at that. So Berkshire Hathaway, $255,000 is a very, very, what would seem expensive stock. But if you go down to the PE ratio or price per earnings, of 18.012. It's basically saying you have to pay $18 for every dollar of earnings in this company. And this, I will admit, this gets a little bit sticky when trying to compare PE ratios between different market sectors. Berkshire Hathaway is sort of classified as a financial stock, although it has its fingers in almost all market sectors, so it's really hard to call it just a pure financial stock. Google, is not in the same market sector, but you can see here its PE ratio is 30.4. So you got to pay $30 for every dollar of earnings. So I would argue this is a more expensive stock than Berkshire Hathaway. In Cara Therapeutics here, you can see its PE ratio is NA, meaning it has a negative earnings. It does not make money. It loses money. So I would say this is a very, very expensive stock because you're basically paying money that will never get back a return. So this is like an infinite PE ratio. Google here, again, 30 for every dollar of earnings, and Berkshire Hathaway, 18 for every dollar of earnings. So even though this may seem very expensive, this is less expensive than Google or Cara Therapeutics, even though the cost is the highest. So I hope that makes sense. So it looks like it's a very expensive stock, less expensive, the cheapest, but really if you look at the PE ratios, this would probably be the least expensive stock. This would be the most expensive stock. And this would be, well, an infinitely expensive stock because it has negative earnings. It's not making any money. So every $15 you spend, you're getting zero earnings back. You're actually getting negative earnings because the company is losing value every year, every sector that it operates because it doesn't have a return on your money. So I hope that makes sense. Just want to quickly talk about that kind of fallacy that a stock is much more likely to go from $1 to $10 than it is from $100 to $1,000. Berkshire Hathaway back in, I think, the late 70s, early 80s, $350 a share or so. If I remember correctly, I may be totally off by that. But the point is it's increased remarkably, even though, at that time, $350 was a lot of money back in 1980. And this stock here, this stock will never increase like Google or Berkshire Hathaway, even though this may seem like the most easily purchased, the least expensive. It actually is the most expensive stock. Least costly, yes, but most expensive. Google here is the stock that looks like it's going to have a good future. PE ratio does also entail some future earnings as well. So investors are more likely to pay for a stock they think is going to have better earnings in the future. So again, that plays a part in the PE ratio, but it still doesn't change the fact that today this is the most expensive of these two here. And this one here, I just included it because it has a negative PE ratio, which is not calculable. And you can see here, this is the most expensive. You're actually losing money for every dollar you spend. So an infinite cost here, the most costly and the least costly. Even though the cost of the, expensive. So I should have said infinitely expensive, the most expensive between the stocks that's making an earning, and this is the least expensive but most costly. So I hope that makes sense. Sorry about flipping the terms here at the end of the video, but if you have any questions about that, let me know. But again, I just wanted to kind of bring that up because I don't think it's true that a stock is more likely to go from 1 to 10 than it is from 100 to 1,000. It really depends on the underlying fundamentals of the company that you are investing in. So don't let the price of the stock sway you from investing in good companies. A good company will always make a return, no matter if it's costly And with regards to expense, if you think the company is going to make good earnings in the future, you'd be willing to pay a little bit more expense for that than a company that you do not think is going to be making better returns in the future. So, hope all that made sense there. If you have any questions, let me know down in the comment threads. I'll do the best to answer you in a timely fashion. Sorry about some of the delayed responses in my other videos. So yeah, kind of with that, I'll end the video. As always, if you enjoy my videos, feel free to like, share, and subscribe. Building the channel, just trying to learn a little bit about the market. I hope you guys have been learning along with me. Any good video ideas, topics, let me know. Yeah, and with that, I'll say adieu and see you next video.